It's the most objective industry in the world. If your numbers stink, you're out. If your numbers are good, you get more money. It's the most Darwinian. It's beautiful. It's brutal. It works. All right, guys, let's roll. Buy 5 HMTT at an eighth. See what happens. It's against puts. We're fine. I want to see if you can even buy it. Colgate opens up an eighth. IBM August 95 calls. I want an offering on 1,000. I want an offering on 1,000. I want an offering on 1,000.
You want 10 more of each?
Yes, double down, double down. I want 10. I want 1,000.
Pfizer, 70 and a quarter. It's X. We get the dividends.
Sold.
A new faith is sweeping the country, gathering strength by the day.
It's 25. It's 25. Okay. It's 25.
Over the years, as a financial reporter, I've watched money manager Jim Cramer turn into one of the market's most avid missionaries.
Colgate, Colgate, Colgate. Get me, get me, get me. There are 1,000 stocks out there that could make you rich, totally independent of what you do for a living. All right? Like if you had bought Merck in the 1950s, just bought 10,000 shares of Merck instead of buying U.S. savings bonds, you would not ever have to work again. 46 3/4 bid Cascade? I believe that stocks like Bristol-Myers, had they existed 100 years ago, there would have been no Marx, there would have been no communism, because what's happened is these stocks have made many millions of people rich, and they're going to do it again. Sold!
Take a look around. We've all become hooked on the stock market.
Within about 14 months, made about 30%, 40% of my money.
I'm up 35% in 3 months.
Yeah, I mean, I did 178% last year, so I'm doing well. I really enjoy it.
I got it.
The 1996 model stock market is the most overwrought, overexcited thyroid case, if you will, we've ever seen in this country.
Last 5-8, 7.5.
We're now using the stock exchange as a kind of souped-up, turbocharged national piggy bank and retirement plan.
People are in the market today because they're afraid not to be in the market. And this represents a tremendous change in the psyche of the country.
Funding for Frontline is provided by the Corporation for Public Broadcasting and by annual financial support from viewers like you. This is Frontline.
Pay 52 for 4,300 General Mills. That's for WD, right? I got you, baby.
For most of this century, the stock market belonged to insiders, men who spoke in a coded language and worked in the arena we call Wall Street.
Here's the Dow Jones Industrial.
But today, the stock market belongs to all of us.
It lists all the publicly traded companies in the U.S.
During a bull market that's lasted 14 years, a time that's seen the Dow Jones Industrial Average rise more than 5,000 points, tens of millions of Americans have become investors.
That would be a 50% rate of return annually.
There's never been anything like it.
I can make twice as much money in the stock market as working real hard in my regular business. And so I think it's an opportunity, and it's cleaner, it's less people, it's your brain and how much time you want to put into it.
And there's a feeling like everybody's making all this money on Wall Street. How do I get in on the action?
I have an office on Wall Street. I can look out the window and I can see people queued up to visit the stock exchange, to kind of go in the visitors gallery and watch their wealth fructify. They want to go in there and watch the stocks go up. It's like they're visiting some French cathedral. They're out there taking pictures in front of this building, this Mecca.
Wall Street is one of the great symbols of the free market, but it's always been something most of us feared rather than embraced. That's what's changed. Today's market, we believe, is there for us, helping to send our kids to college, or to provide our retirement nest egg, or to make our lives better in 100 different ways.
This is corporate America at its finest, where the little guy gets to go in and buy a piece of Walgreens and be co-owners with all the rest of the Walgreens, Charles and all the very nice people. And we are part owners. We're not gambling.
Good morning, everybody. This is Gary Goldberg on Money Matters. Welcome to the program, and we are here to...
Today, everybody's a part owner.
Because for the first time, many of you have decided to invest.
And they all want to talk about it.
Hello, Sharon. Good morning.
Hi, thanks for taking my call.
You're welcome.
We currently have most of our savings invested in the stock market. We're investing, making a profit, and selling it so we could pay off our credit cards, set up retirement, and the college for the children.
We found Sharon and her family in upstate New York. They are modern American investors.
We don't have any retirement, owning our own business. That's why we're in the stock market. We're trying to make some aggressive money very quickly. Russ works very hard. It's almost demeaning that he works this physically hard. He should be more mental.
How much of your savings are in the market right now? How much of your life savings?
Almost all of it.
Almost all of it.
Almost all of it, yeah.
As the whole industry continues riding high, but there are some clouds on the horizon.
Gee, IBM's 95, and I see Nike went up to 108 also. I could sit here all day and watch this, and just watch them go up and up.
As inflation remains well in hand.
Stop. Guys, come on. 111 and 7/8. Down 2 5/8. It was 125. I guess everything's still falling. Russ started watching CNBC, and I put it on at the carpet store. I just put it on one day, and I just watched the ticker tape go by. The stocks were going crazy. Some of them were starting at $10 and going to $80 a share.
Something like Microsoft. When I first started watching it, I think it was almost $50 a share. What was that, about a year and a half, 2 years ago? And you sit there and watch that stock go up to $120. Yeah, you get kind of giddy about it.
What kind of stock do we have?
Microsoft.
Yeah, what are those? What are the call letters?
MSFT.
MSFT. If you look at the stock market, the overall, when it started back 100 years ago, the stock market was here. It's 1996, and it's up here, and it's gone up and down, but eventually it has ended on the up.
Sharon and Russ live in a small and modest house, but they have big plans.
This is our dream house. Look, here's the plans inside. This is where we're going to live in the back. It's a nice big great room. It's got an arch window up the stairs. We all picked out our own bedrooms. We look at it when we're off to work in the morning and when we come home tired. It's just like an incentive. Isn't that beautiful? Isn't that nice?
The investment industry has aggressively courted baby boomers like Russ and Sharon. And no part of the industry has been more aggressive and more successful than the mutual funds, which offer people the alluring prospect of handing over their money to an expert, a fund manager, and watching him make dazzling gains.
85% of the money now in mutual funds has come in since 1990. So far in 1996, we've had more money come in into stock mutual funds than in any previous year in history.
Good morning and welcome to another mutual fund conference. It's a pleasure to see so many familiar faces and welcome you back. A little concerned about the beautiful nature of this room and can't help but wonder what that tells you about where we are in the market cycle.
By the spring of 1996, when we attended this mutual fund conference, the fund industry had topped the $3 trillion mark. That's more than the gross national product of France or Germany. And much of that money has streamed in just the last 3 years, as the market has made some of its most spectacular gains.
There are 7 individual mutual funds. There are 400 mutual fund families, all with their product wares spread out for you. There are bond funds, there are emerging market funds, there are Canadian resource funds, and if you want to invest in something and you can't find a fund for it, wait 15 minutes and someone will devise a fund to sell
We
to
have
you.
15 no-load mutual funds, the Emerging Growth Fund, Capital Appreciation Fund,
We don't invest in companies involved in the manufacture of weapons or the production of nuclear energy.
Value Fund, Growth and Income Fund.
We generally tend to pick stocks that pop up on our buy list as a result of our computer screens.
Government Fund, and Reserve Fund.
I have to ask you, I've never heard this before. I've never heard of anybody with a Nebraska tax-free fund.
Well, it's both federally and state tax-free and invest in municipal bonds.
But you have to live in Nebraska to get this.
That's right.
Is it just our imagination, or do these funds all seem to do nothing but go up?
The small cap fund, which is directly correlated to our managed accounts, is up 36%.
It was up to 20.41%. Last year was up about 59%.
1,000% or something?
I don't know if it's that much, but it's certainly approximate that.
And the better these funds do, the more the people who run them seem like superstars.
5 years from now, I think you'll be able to name the top 25 mutual fund managers in the country in the way that you'll be able to say who runs IBM and who runs Ford Motor and who runs...
And in time, and really not so long, stock market got back to where it was. And that led to the feeling that in the long run, being in the stock market is great, that weak markets are buying opportunities, not times to sell. This wonderful event in 1987 is what people today are carrying around in their heads. Don't worry if the market goes down, nothing bad can happen.
After the crash, American investors embraced the market, and especially the mutual fund industry, with renewed fervor. Today, 1 in 50 American households has money in the Magellan Fund, and the customers of Fidelity Investments alone constitute some 4% of the country. There's a huge amount of money that flows through here. I mean, we're talking about billions and billions of your and my money, America's money.
Absolutely. We do, it's public information, we do between 5 and 7% of the trading on the New York Stock Exchange.
Comes out of this room.
This room, right over on
these
here.
people.
You got it, these people.
Even after he retired from Magellan, Lynch remained a fanatical popularizer of the stock market. But he had one important caveat. You needed patience.
My best stocks have been the third year I bought them, not the third week, not the third month, the third, fourth year. People want something to happen in a week and 2 weeks. It doesn't work that way.
You got it on. KNBR 68, San Francisco.
It's only been 6 years since Lynch left Magellan, but today's fund industry has a whole different mindset.
Garrett.
Yeah.
MDI, we're going to try to cross 75 G's, 7/8 the figure.
Okay.
Do you need to be involved either way?
No, thank you.
Asking? No?
No, thank you.
No interest?
No interest.
Yes. No, thank you. Next. Hey, if you hear of any pieces of cardiac pathways down in the hole this afternoon, give me a call, please.
AAS, you sold a whopping 800 shares at 32 5/8.
That's what I like.
Beautiful.
See you later. Bye. God bless this country.
Garrett Van Wagner is still the new kid on the block,
Yes.
but the comparisons have already begun.
Yes, I do.
How do you feel when you get compared to Peter Lynch?
A little embarrassed, a little bit surprised, and flattered, I guess would be the things that come to mind. He's a legend in this business. Does he want to come out of the position, or is it just trimming? It's going to be a long time before I'm willing to sort of accept that kind of status. I'd like to do it for 10 or 15 years first.
But Garrett won't be given that kind of time. In the overheated market of the 90s, fund managers are scrutinized not just year to year, but week to week and even day to day.
This is not a charitable business, charitable institution.
By the summer of 1996, Garrett's fund had long since hit its peak of 60% and was stumbling badly.
Yeah, under 45, give me a holler.
Thousands of people who came in at the top were losing money with Garrett.
Right, I want it flat on its butt.
How much did you lose yesterday?
I lost about 18 million in the big fund. No, too high.
And that was the worst day you've had since you opened for business?
Worst day I've had since I've been open for business.
You've got a tremendous amount of money in that fund that came into the fund after it was up 40 or 50% or 60%, with the expectation that that's what the future is going to look like.
My guess is, as he got close to being up 60%, he probably raised 80% of the money he has under management. So it's quite likely that the overwhelming majority of his investors, their first taste of his performance was a sharp setback.
Under this kind of short-term pressure, Garrett doesn't have time to buy and hold the way Lynch did. His strategy is all about moving in and out of stocks quickly, sometimes in a single day. Always he's taking the pulse of the market, trying to stay one step ahead of it. It's high-stakes poker.
I got one more for you today. I've got 25,000 RXT to buy with a 6 top, please.
What's particularly dangerous about the present mutual fund boom is what is called investing is really speculating. The techniques are more about trading, rapid turnover, paying any price for a stock as long as it goes up or behaves a certain way. It is about crowd behavior and stock price behavior, not about analyzing the underlying businesses.
God bless this country. Let's feed the old ducks while they're quacking.
The companies Garrett is investing in aren't Dunkin' Donuts and Kentucky Fried Chicken. They are mainly technology and healthcare stocks that most of us have never heard of.
HNC Software has gone from up 1 to up 7.5 in about a minute and a half.
New companies with little or no track record.
Marking them up.
The way the fund industry has changed has been to liberate fund managers to pursue hot performance anywhere they can find it. And the result of that is, when you buy that fund, you have no idea what that fund manager is going to do with your money. He's free to put it in almost anything.
That's what I like.
Garrett's stock picks are among the most vulnerable and volatile around. But at the end of the day, they can produce eye-popping results.
Oh my God, look at Integrated Systems today, up 8 3/4. What, did they discover gold?
Do you make money today?
Yeah, we made good money today, actually. And we had some real high flyers today, so we had a good day today.
Do you have a guess how much?
I'm going to say we probably made about 13, 14 million. It's going to be a guess today.
Actually, he guessed wrong. It was more like 22 million.
Not bad.
Not bad.
The problem is that all of the mutual fund managers, I think, are trapped in this rather deadly, vicious circle, that the more successful they are, the more money flows into their mutual fund. The more money that flows into their mutual fund, the more difficult it is for them to beat the market averages or even to match their own past performance. And I think that we may see future situations like that of Jeff Vinnick at the Fidelity Magellan Fund, where mutual fund managers will try to do very strange and unconventional things because it becomes increasingly difficult to outsmart the averages.
Jeff Vinnick was a young whiz kid at Fidelity when he inherited the Magellan Fund in 1992. Within 3 years, Magellan had ballooned to over $53 billion, making it by far the biggest fund in the country. In early 1996, Vinnick made a dramatic move, shifting Magellan heavily into bonds and out of stocks. He was betting, in effect, that the bull market was about to end. But he bet wrong.
Jeffrey Vinnick made a bad guess and bought bonds and missed out on a truly, wonderful levitation in the stock market, and had the epaulets of a celebrity stripped from his shoulders and left Magellan Fund.
The man who runs the world's largest mutual fund has resigned. Jeff Vinnick.
Jeff Vinnick's departure should send up cautionary flags for the mutual fund investor.
Magellan's returns this year have been well below most other comparable funds.
His departure means that people are really not willing to take short-term underperformance in the expectation of future return. I think that's the really scary thing, that he really only underperformed for a couple of quarters.
The public's impatience for big gains is so great that many people have taken investing into their own hands. The internet is crowded with hot stock tips, financial chat rooms, and lots of so-called advice.
Here they are.
One of the most popular sites on the net is an online investing forum called The Motley Fool. Its founders, two brothers named Dave and Tom Gardner, claim that if their subscribers invest their money the Motley Fool way, they can count on 20% growth in their portfolios per year, guaranteed.
We've identified a couple mechanical investment approaches which can be used by anybody, take only about 30 minutes a year, and for more than 25 years have returned that 20%. And we don't see any big change in the next 25 years. So when we teach that approach, we're teaching people financial self-reliance.
The Motley Fool is based in a townhouse in Alexandria, Virginia, and staffed by 20-somethings who, like the Gardner brothers, are true believers in the market. They lead their 250,000 subscribers in a vigorous hunt for the next big winner.
Microsoft 10 years ago, had you bought it, not traded it with your broker recommending that you trade it, not in a mutual fund where it would have been diluted by 60 other stocks. Had you bought it, it's grown at 60% a year. So $10,000 is worth $1 million 10 years later.
The problem is, how do you know which of the thousands of hot stocks out there are going to turn out to be the next Microsoft? That's the hard part. And it's something Motley Fool subscribers found out the hard way. The company was called iOmega. In early 1995, it came out with a jazzy new computer device called the Zip Drive. Motley Fool subscribers fell in love with the product and started an online bulletin board devoted exclusively to iOmega. In this electronic hothouse, the stock caught fire.
And so we bought the stock at 2.5, added it to our online portfolio, and over the course of the next year and a half, it ran up as high as 55.
When the stock was at 55, our $5,000 investment, think about it, was worth over $100,000.
As the stock attracted more and more attention, the Motley Fool chat board became a frenzied, giddy place. The more iOmega went up, the more of their livelihoods people poured into the stock. By 1996, the iOmega phenomenon had spread well beyond the internet. Last summer, at a Charles Schwab office in San Francisco, people were talking about little else.
iOmega was the talk of the town, so to speak, on the stock market. And I would read about it, and I would see that it would rise incredible amounts in a day.
I bought it at 24, and it went up to 80, and it split. And after it split, it went back to 54.
The next morning, I woke up and called up the broker, and it was at 55. And I was like, this is kind of silly, but it's great, you know. iOmega is 19 million. Look at that.
But what had the company done to deserve this kind of run-up? Not much. It was a 3-product company with profits of only $14 million. But at the peak of the frenzy, iOmega's stock was worth over $5.5 billion.
Stock prices going up caused people who would not have dreamt of buying them when they were down to go out and buy them, because after all, they will continue to go up. And the manifestation of this psychology in the marketplace has been an extraordinary array of overpriced specimens, companies that changed hands at 600 times the sum of money they can expect to earn this year. Literally things that are seen once, twice, or 3 times in an entire investment lifetime have come to pass in 1996. It has been a living museum of speculation.
In iOmega's case, it was a bubble that was destined to burst, and eventually it did.
And I watched it go from 55 to 54 to 53 to 52 to 51 to all the way down to like 48. And I go, I sold at that point.
And I put in a stop and sold it at 40, 43.
So, and the yearly high is 55 1/8, and it's down now to 23?
Right. iOmega's been dropping like a rock for a good week or 2 weeks.
And the Motley Fool boards were full of howls of pain. Show us iOmega here.
Okay. This has been a very severe correction for
look at
iOmega.
that.
The real hype, Motley Fool hype, was right around here.
it was a good horse, but it was just a horse, and you had to get off it. And there are other horses out there. Try to pick a horse that's not a sprinter. Try to pick one that's going to be around.
The stock got ahead of itself, as often will happen with great growth companies, we think. And so somebody could have bought the stock at 55 and seen his investment melt down to about 21 today. Now, at the same time, many other people bought at 2 and 5 and 10 and 15 and 20 and may have sold at 48, for all we know.
In Japan, they had a name for this. They called them the Shinjinri, and it literally meant new human being. They were the 20-something-year-old people who had had no experience in the market who were put in charge of all the investing, and they thought that nothing would ever go wrong.
The Japanese stock market, which had been the wonder of the 80s, crashed in 1989, and it's never recovered. Even today, the Japanese market is just over half what it once was, and once euphoric Japanese investors now feel burned.
I find it somewhat ironic that here we are, 7 years after that bubble burst, the Japanese are still trying to pick up the pieces. At that moment in time, we are doing many of the very same things. People are buying stocks for one reason. They are going up.
I have 2 kids I want to put through college, and I figure this is the best way I'm going to be able to double my money.
Necessity is the mother of invention, so I've heard. And I have a wife and 4 kids. I'm a policeman in the city here, and I figured I needed to make some more money.
Why not just put it in the bank?
Well, the bank only pays you 3%, and it makes you feel like you're not gaining ground, and the stock market's faster.
People have confused need with certainty. We need this to work. It seems like it will, therefore it will. That's a little bit like going to the track and betting on number 3 and saying, God, I really need this horse to come in for me. Well, just because you need it to come in doesn't mean that it will.
It's funny that people are motivated by anxiety to take a risk. You'd think that anxiety would make them risk averse.
Let's go. Time to go home. Come on.
Sharon eventually sold Microsoft. The next time we caught up with her, she and Russ had put their life savings into 2 tiny, volatile technology stocks. Why?
Because we're working very hard and not furthering ourselves. It's too slow. We have got to do something aggressive.
It is scary, but, you know, I guess, at this point, she just wants to, Sharon, well, actually, she took a little more and just invested recently that was very conservative, and she kind of went and did something that I think we'll make out on, as long as the market doesn't crash. But yeah, right now, just about everything's in there.
What'd she do?
She went and invested in a stock that she was told was going to do very well.
To tell you the truth, I don't even know the name of it. I know the call letters are AMLN. It's supposed to double by August.
Do you worry about your future financially?
Oh, yeah. All the time. That's why we're trying to do something. That's what I'm saying. There's really nothing to depend on except yourself. So, yeah, we worry about it.
The money that people used to put in the stock market was money that they hoped to get rich on or get play with or maybe finance a trip to Europe or something. What's going in today is blood money. With jobs less secure and with really the wonderful corporate pension fund that promised you a pension of X% of your final salary when you retired, with that no longer as important and taking care of a smaller and smaller proportion, this is blood money that's in there.
I think that what has been happening is a kind of fear approaching a panic that's spreading through the baby boom generation, which has suddenly discovered that it will have to provide for its own retirement.
If retirement is a bridge to be crossed when we get there, then let us begin.
Have you thought about how much you're going to need to retire?
Sure. I have. I think I'm probably going to need anywhere between
$1 million and $1.5 million to retire.
That sounds like a lot of money.
It is a lot of money.
Are you there?
No. No, I'm not there.
All these particularly late baby boomers, people in their late 40s and 50s, they've been spending their whole life. They have not been saving. And now they see their retirement not that far off, 10, 15 years. Hey, people don't believe there's going to be any Social Security. There will be something called Social Security, but it's not something you're going to want to live on.
The stock market was not a factor in my parents' lives. My father was a member of the union. He had a pension. He retired at 60 years old, and my mother still lives on the survivor's benefit of that pension.
And that's never been a possibility for you?
It was not the road I chose. I'm counting on the market for my retirement. Micron Technology up a quarter, 1.25. Excellent.
With so much riding on the market, we seem to have forgotten what a fragile and human instrument it actually is. How much its movements depend on how we feel about it. Right now, at a moment when we're counting on the market as never before, we feel it will always take care of us. But will it?
In nature, in life, in everything, there are cycles. There's no such thing as the elevator that only goes up, which is what the stock market is in people's minds now. The risk is that if that process gets started again, and we only traverse back to what the average level of expensiveness, never mind cheap, like we were in 1982 when this bull market started, but if we only get to average, that would mean a decline in the stock market of 50%.
In other words, just to revert to its historic norm, the market would have to lose some 3,000 points.
What'll happen is we will simply get too high. There won't be enough new money coming in to keep the market going up. Losses will start, and losses will beget losses, and then people will be people, and they'll sell.
500 to 95 is 500 of the pars. 500 to 95 is 500 of the pars. Buy me 5 ain't it. Buy me 5 ain't it. I want to bring in these shorts. I want to bring in the Gadzooks, Outback, okay, the impossible stuff to buy, and HMTT.
The real trap for any investor in a market that's been as volatile as this one, where rumors sweep through the internet, is believing that you can get in early and you can get out early and you can beat the consequences. And of course, if everyone believes that, it means no one gets out early.
I want another 10 Boeing. It's absolutely right, okay?
It may be true that over time, the stock market will outperform other forms of investment.
10,000 trades, 7 8 right here.
But it is also true that you can take 10, 15, 20-year slices out of that long track record and find very disappointing returns. For example, if you'd invested at the height of the 1960s go-go market in 1968, you didn't recoup your investment until 1982. If those happened to be your retirement years, you were in real trouble. There is no immunization of the American stock market that keeps us from ever having a long, dull, grinding bear market. It could happen again.
One of the things that I find myself worrying about is what would happen if we had a sustained bear market after a lot of the baby boomers had retired. They were all past 59. They were beginning to draw from these different retirement plans that were invested in the stock market. And yet suddenly their stocks were underwater. On paper, their investments were down 30, 40, 50%. What would they do?